The concept of fair value gap is something many people in the trading industry have heard of. They have a basic idea, but they don't know how to use it. So in today's video, I will tell you how fair value gap and inverse fair value gap work. There are many, but how to spot the best ones. I will also show a real example where I use this to make 12 lakh rupees, after which I am making this video for you because I had posted it. So let's start this video. So first, let's understand what this fair value gap is. So fair value gap or inverse fair value gap. Once you understand FVG, you'll start to understand inverse FVG as well. Fair value gap, it indicates an imbalance. Imbalance means when there is an imbalance between buyers and sellers. When there is a lot of buying, it is called an imbalance. Like suppose a green candle forms here. After that, a very large green candle forms. Okay, the next candle can be red or green, but let's say it forms a red one, for example. So such a candle forms. So whenever we get a structure like this where the middle body is very large, the body appears as a long candle. It can also be in the wick, but we are talking about the body. Which time frame will we understand? So if I call this candle number 1, this candle number 2, and this candle number 3, then it is in the 2 candle between 1 and 3. Now the distance from the top of 1 to the bottom of 3. It is between the high of 1 and the low of 3. If I create a gap here like this, it will be called a fair value gap. Many of you might already know this. Those who didn't know have now learned. This is called a fair value gap. Why is it called that? Look, because after this candle, such a big candle formed here, it means that there is definitely institutional money, smart money involvement here. If large traders are making such significant purchases in gold, Bitcoin, or any Nifty, a retail trader cannot move the market that much. So this level indicates a lot of interest. This gap shows an imbalance. Now we will come to the point of how to trade this. Okay. Now before that, let's understand how a negative side will form a fair value gap when a red candle forms. Suppose after that a very large red candle forms. Alright, after that a green candle forms. Suppose a hammer forms. So how would the fair value gap form here? We will say it again and mark it. This will be called 1, this will be called 2, and this will be called 3. The difference between 1 and 3, like from here we draw a line like this and it's high. So this area that will be formed will be our fair value gap. Okay, so first I have explained the basics to you about what a fair value gap is. Now we will go to the next level and understand that we also need to learn to draw another level in the fair value gap. That is the 50% here. This will also be useful for us. And we will learn about something called premium and discount here. I will tell you about that later. So we have understood the fair value gap. Okay, so how do we use it? So how do we use it, guys? Let's take an example that if suppose a green candle is formed in the market. Okay, a green candle was formed like this. After that, a green candle with a very large body was formed. Here, after this, a red candle was formed in the market, for example, like this. Where will the fair value gap be formed? The fair value gap will be formed in this area. This area is fine, and I have also drawn a middle line for you here. Now, what trade do we need to make? The market concept says the concept of the fair value gap says that the market will definitely come to fill this gap. Now, whether it will fill completely or 50%, the price action will tell, which we will see in examples. Sometimes it will come to this level, sometimes it will come to that level. If we get a bullish candle at both levels, we need to go long here. This is the concept of the fair value gap. It means if the next candle forms green here, many times we feel that the stop loss will be hit. It makes so many red candles, makes another red candle, and if it creates some action like this somewhere here, so this becomes a very good entry for us. We get a very good long entry here. So this is the concept, guys. We need to make our buying at this point. And by buying at this point, we need to capture a long trade like this. The stop loss is also small. The target we get is 1:3, 1:2, or 1:4, depending on the resistance level here. This is an example of a bullish fair value gap. Now I will give another example. And when this fails, it creates an inverted fair value gap. Stay tuned and let's understand it now. First, let's understand a bearish example. Suppose the market forms a certain type of candle, it falls. And always remember, many fair value gaps will form. In fact, there is an indicator for extracting them, but it extracts everywhere, the indicator that is. That's why I will tell you to trade only on fair value gaps with large candles. Only then will we get good results. I will show a live example, no problem. So what will form here is a fair value gap, this and this. Where will the middle point be formed? This will be the middle point. How? There is a scale on TradingView. I will show it. We will create it using the scale. So now our concept says that if I short here on this candle, suppose a red candle forms, I won't keep such a large stop loss. So here the risk reward becomes unfavorable because I need to reach the target up to here with such a large stop loss. To improve that risk reward, sometimes it will directly fall. No problem. At least you won't lose your money. Learn to leave such direct breakouts if it falls. But if the market makes a big green candle here, makes another big green candle, but by the time it comes here, for example, it touches and makes a red candle like this, then this is a shorting point for me. This will be my short entry. Here I need to make a sell entry, or basically a short sell entry. I will get a small stop loss and a big target. So that is my goal. This is how the fair value gap works, right? I explained this concept to you on the iPad, and I will also take you to the screen and give you all the examples one by one. Before we go to examples and directly go to TradingView, let's learn what is an inverse fair value gap. You have seen what FVG is. Now, after FVG, we will understand what an inverse fair value gap is, because if you ever take an FVG trade, let's say, and it fails, then you can also take an inverse FVG trade. Sometimes it won't fail and you will directly get an inverse FVG trend because it will be mitigated directly. Basically, the gap you have will be filled. In short, it will be violated. There are many English words, meaning it's very simple. We will understand. Okay, now let's understand a bullish example. First, we saw that a small green candle forms and then a large green candle forms. And only when a large green candle forms will we pay attention. Otherwise, see, fair value gaps are formed like this as well. There was a candle like this, then a candle like this was formed. Then such a candle formed. So here too a fair value gap was created. But these examples don't work that well. Your first and third candles should be small and the middle second candle should be quite large. If you start applying just this small quality difference, because the indicators you get, on TradingView, there are free ones and paid ones. They are all catching FVG and you are trading it and making a loss. So if you feel that this thing doesn't work, the video is not useful. So watch this completely, and after explaining the whole concept, apply it. You will enjoy it a lot. Let's move forward. Suppose the next candle is also green but smaller. Then where will the fair value gap form, guys? It will form here. Now the market says take out 50% of this. Now the market says, okay, yes, this 50% rule. What happens now is the market fair value gap. This is not an example of the inverse value gap. In the fair value gap, when the market goes down this area above, right, the market turns from here too. But when the market from this area, so it's thought to be a really good spot because the risk of loss is found to be minimal. Even if you enter here, you have to keep the loss limit low. That's why they divide this area. Entering at a lower level is called a quality entry. We can use the words low quality, premium and discount. Okay, let's come back to the concept of inverse fair value gap. Now, what is the market saying? Now, we are expecting that the market will decline, form red bars, and where green bars appear, we will trade, but a market surge disrupts this. Here the concept failed. And look, the best part is that a long entry wasn't even made because a proper closing will happen when a green candle forms. On a 5-minute time frame for intraday, if you want to hold a little longer, then there is the 15-minute time frame. If you want to hold the trade for 4 or 5 days in an hour, and if you want to finish your trade in half an hour or an hour on the 1 minute, then I have also told you the time frame. So what happens here? People then close their laptops and leave. Forget about it. But if you check this carefully, what happens? Do not delete your levels, neither delete the middle center line nor the fair value gap, even if it has broken. Now, if the market comes to this area, there is a green candle, right? Do you remember the retest concept? What does it mean the market did? It broke out upwards, but it failed. It came down and fell like this. So we are trying to find this trade. Basically, you understand this trade, brother? And it will be understood very well in the live example. So we need to wait. If it forms a green candle, forms another green candle, and somewhere here we were basically looking for a long trade before this, correct? You are finding a long trade. Now we are finding a short trade. And now I find some candle like this. So guys, this is an advanced concept. You sell here, put a small stop loss, set a big target, and this is the inverse fair value gap. We will understand with one more example, then it will be clear to you. The sell side one, look, the market fell a lot. We know we are looking for a sell entry. We have created a fair value gap. We have also made the middle line to know the premium discount so that we get a better trade from the top side. A small stop loss gives low quality. You can leave it if you want. You can catch the trading of this area. You can do this too. That's why we are making the middle line. So we will come here. If you're new, subscribe. Great content is coming. Let's get back to work. Now tell us, guess which trick we are looking for, sell or buy? First, we don't know if it will be inverse FVG or FVG. So obviously we are trying to trade fair value gap. We are planning to sell. So we were planning to sell. Great, brother. It came hoping for a red candle bomb. Something like that happened. So now what do people do here? They close the laptop and leave, but here there's a chance to create an inverse fair value gap. Now, if the market comes here and forms a red candle, comes here and such, the entry will remain on green, and this will be my entry point, guys. I have to make my entry here, place a stop loss at this level and set a target at a higher level of 1:2. Or you can also place your stop loss at this candle because the market usually doesn't break it again. So actually the right stop loss will be here below this red candle, and this will be your big target. Okay, so I hope you enjoyed studying what an inverse fair value gap and fair value gap are. And where do we apply this? These concepts work in all markets. Now I will take you to the laptop. This works the most is in the Forex market, international market, gold, crypto, and crude oil. For trading all of these, I would suggest the right broker is Exness, which I personally use, and you will find the link in my profile, which gives you many benefits if you open through my link. The second is an app called Market Genius that I created where I provide you with trade guidance for free, and you also get access to it. Now, all those things will automatically be known to you by joining my Telegram channel. Just open it and install Market Genius, and then you will automatically start knowing all these things. Now we will go to my laptop screen. First, we are looking at this Ethereum chart here. It's a 1 hour time frame, so you can also develop it on an hourly basis. Even in an hour, I will show it. In 15 minutes, I will show it. Even in 5, I will show it. So here you see where you can spot the big candle and where you can see the gap in it. So the best gap I find, which also has many like here and here as well. This is also here, and this example too, I will explain to you. First, look at this example, how this candle forms, when this candle formed. And here I made it the height of this candle. Okay, so how this candle number 1, this 2, this 3, I pulled it forward. So when I pulled it forward, the market went up so much, I would make a big entry. I don't know where I would place the stop loss, and if I entered, my stop loss would be hit. So I deliberately waited for the market to come into this level. Now, what did I say? How to pull 50%? See this. What did I say? Come like this. Come here and draw a 50% line. What is the benefit of drawing the line? You will avoid cheap trades, meaning you can avoid entering until the market turns from somewhere here. And you can enter when it turns from inside. Like the market came from here but didn't give a closing outside. Then what did the market do? It took a perfect touch handle. If we enter here, what did I say? My goal was, after touching below this 50%, if we enter here, place a stop loss. This is a simple example of a fair value gap here. And we know the market has given us a run up to here last time. So pull this. So we get 1:3.32. See, I'll tell you a secret why it happens that while booking the target, your market reverses, because this is visible to everyone. I can see it, you can see it, everyone can see it. So deliberately make your target a little smaller. Not 1:3.4, but 1:3.12 is needed. So we have to book this trade in this way. All right, now I will show you more examples of the fair value gap, 2 or 3 more. Then I will show examples of the inverse value gap. If you are enjoying the video, please like it. I am setting a target of 5,000 likes. All right, guys, so this is the USDJPY chart. The market is giving a good downtrend. Middle candle should be big, okay? Middle candle. It should be large. The middle candle is large. And this is also a slightly large candle, but it's fine. We mean that there should be a gap, and the gap should be good. So we observed that a gap will be marked from this candle to this candle. I'll draw it forward. This is an obvious thing. This will also become a trade. This will be the first trade. So I genuinely have to set my stop loss for the gap I have. Now see, your stop loss gets hit, but the target doesn't. Why does this happen? Why does it happen? Because you can see it. If this is my box, I'll place it here. It got hit, right? A bit stingy, like what was taught in the target, exit a bit early, set a slightly larger stop loss. Don't be stingy here. Be stingy with the target, not with the stop loss. That's how it is, okay? We know the market has run up to this point, correct? So what will we do? The same, and we will take the target up to this point. No, a little higher like this. So we will see here what the market does for us here. It gives a target of 1:38. Now, I will teach you something called the pyramid. What is the pyramid concept? What do we always do? When we go into a loss, we start increasing our quantity. The biggest thing is that when in the red, you should not increase the quantity. This is called averaging. Many people are in loss by doing this. It has become a habit that when there is a loss, increase the quantity. This is called averaging, which is a very negative thing and a losing strategy. But if you do pyramiding, now what happens? We placed a trade, went short, started moving in our favor. The market turned well and gave another opportunity. Again gave an opportunity. So look, when the market touches this level again, where does a good red candle form? It's visible here. I'll move this aside a bit. Look, a good red candle is visible here. Okay. Grab this point or grab this point or grab this point. Let's grab this one. Let's grab this one. So if we enter at this point, even if we increase our quantity, what will we do? We have placed one trade of ours and activated another trade here, and in this way booked a double target. The risk is very small, so in this way you can make money by not averaging but by pyramiding. What do you need? Saw FVG at 15 minutes, executed at 5, and what I did was let it come into a good zone repeatedly. Okay, I let it come into a good zone here. If my trade is a sell, if this is my victory, my sell trade, then I would like to sell above this 50% here. If my buy trade is within FVG, then I would like to buy it here, not here. This was a small new addition for you all, which if you follow when we talk about premium and discount, it will be very useful for you. Now I will take you to the gold chart where I took a live trade and I will show you this trade. I also made $13,000 in this trade and I will show that too. Look at this big candle, guys. 0.42% is a $12 candle. Now, what am I doing? I'm just showing you a short story. Whenever such a big candle appears, it becomes even bigger than the previous 236 candles. Now, obviously, I will short here. Yes, I will short here. Should I keep such a big stop loss, man? I will keep such a big stop loss. It worked by luck. If it hadn't worked, then there would be no point in risk management. So what do we have to do? We have to wait. What to do? Simply come. Develop a fair value gap. This is my first point. I made my second point. Draw a 50% line and make a rule that if the market trades above this level, this is my sell zone over here and I get a good entry near that level. Place the stop loss above this candle or above this zone. No problem. Look how far the market has fallen before. It has fallen up to here. It has fallen up to here. So what you do is cut it here. So here you have to actually, the risk reward here was 1:4 because I kept my stop loss a little small. If you come here, we have two supply zones for sell opportunities. A bearish candle will give us, and this is a gold chart, guys, which I am talking about. Look, I have properly marked the zone for you all and informed you that we are starting with a sell trade. I mentioned that the first target was 1:4. Booked 100 pips. But still, I mentioned that we will hold. This is dropping, held one store for. And you can see $13,000 were booked, and not just me, but 25,000 people also watch this trade together. It's a free of cost channel. It has 225,000 followers now. So definitely join this. You will get a lot of benefits. I have provided the link in the description. Now let's look at an example of the inverse fair value gap. All right, guys. So now I will show you an example. Look, you can see a great big candle here. I came here in gold with a red candle, and here simply an inverse fail. I am trying to create a fair value gap. I want to sell. All right. I came and took out my 50%. I drew the 50% line that when it gives a red candle above this line, I will sell. What did I see? Bro, this broke. What do people usually do then? They leave it and shut down the laptop. What do we need to do? Wait for the market to give a green candle. Cheap entry, as I said, above 50% is a cheap entry. Stop losses are higher in this, and I am showing you an example. Obviously, not everything will work. It will work like 5 times, 6 times, 7 times at good times, but not all 10 times. So keep this in mind when you backtest it. Trust me. Watch this video now, take notes and check for yourself. You will understand the rule I am telling you, which is to enter only from a proper good spot below 50%. Here you make your entry, go long. The stop loss is clearly telling you that this is the point. If you set it at this point, still be a bit conservative and set it slightly lower. How far has the market gone before? The market has gone up to here before this. I always prefer the body. You must have always seen I prefer the body. The body works better than the wick. Anyway, if you have any doubts, feel free to ask in the comments on. Now the world knows that the market will go up to here. See, it fell from there, right, brother? I will deliberately set the previous target, such a target. So if you look, this makes a very beautiful trade here in this way, and it develops for you even in 5 minutes. It's not that it will only work in 15. This will develop properly in 5 minutes. And in 5 minutes, I might even get an entry quickly. My entry won't get an entry. Ours will still be here. And look at this. What a lovely trade it is here. One store to 0.6 is formed. What happened? Breakout happened. Inverse farewell happened. We were looking to sell in the market here. I didn't get a sell. Then directly, but breakout happened. So it went inside, touched the 50% line and went up. So I entered. If it touched here, it would have been even more beautiful and a 75% win rate situation. Let's look at an example. So again, it's the gold chart. In fact, today is the 17th of January when I am making this video on the evening of the 17th. And you can see here that the market opens with a gap up. It fills this gap, but creates a new fair value gap. So I create the fair value gap here. Now, what is my intention here, you tell me? I'm looking for a sell trade here and I will mark this in black first. What am I doing here? I am looking for a sell trade, right? Because obviously the market has broken down. Now it will give me a good sell trade somewhere. Okay. So what do I have to do? I have to make 50% here and I found a good quality sell trade. Where did I find it? I found it here. I need to short here. As soon as I shorted it, what happened there? This is the example I was talking about. Sometimes such lows make us frustrated and we leave it. But look what happened now. See what happened here in front of you and I shifted in 5 minutes. Now I had sold at the red candle here on this candle and I had placed the stop loss somewhere here. My stop loss got hit here. Booked loss. Now see what market has done is break it. People will delete it. But if you look then... Now, it gave me a perfect entry again at 12 noon. Even though it didn't give me from its 50% zone, it gave us entry here and we can enter here and keep the stop loss a little below 50%. Or look, this is also a wick. Put it a little lower. And if you see here, the market came here a little earlier. So exit a bit early. This is also a trade for this point. Okay, this is an example of a trade which I also avoid because it is made from upper levels. And let's see an example. And I guess this is the chart of that USDJPY. Seeing such a big bull run, I felt like did it give me a signal before giving this bull run so that I can catch it. So look here, see this. I am a teacher. My job is to show all the examples, not to take them. I have informed you. The lower box, whatever 50% lower batter we are, whether to take or not, you will do all the back tests, right? So do the back test. That's why I gave all the examples. Now look at this example. There was such a big bull run. Could I have caught it? Look, a red candle formed here. There is a fair value gap here. You see here, we created a fair value gap. We created a short position here. Forget about the 50% we shorted. Then what happened to us? The stop loss got hit. Okay, when the stop loss gets hit, what do we do? But accept it. And what do? Move on and wait. Market breaks out. The market went above the red candle. See what a green candle it made. We won't enter on the red. What did it do? It grabbed all the liquidity, meaning it went to that lower level and wick. What does it mean? We will make our entry long on this candle. Now we can all see that the stop loss is visible to us. Set it a little lower at this point in the market. Had the market gone anywhere above this before? It hadn't. Oh, it had. How far had it gone? Body, this is my body. It went up to here. I will come here and if you see the stop loss here, my target is okay. It is 1:1.2. So I will not accept it. If you ever get a trade below 1:1.5, leave it or see what the target ahead could be. The target ahead is this part of the body. This one could be. So until we get a risk reward above 1:1.5, this is it. I will exit a bit earlier. Now let's see what risk reward is forming. So this is how you trade, guys. So 1:2.5. See, we achieved such a big bull run. So inverse fair value gap. I will revise it immediately. All right, what is the market doing? The market went down. Our job is to sell it as a fair value gap. But if the market breaks upwards, then we try to catch this trade at 50% here. This is called an inverse fair value gap. So I hope you enjoyed watching the video and learned a lot. Now it's your job to backtest it after watching this video, make notes, set things according to your understanding, and as I explained, pick up the trade from below 50% for long and hit the sell from above. If you check this in backtesting to see which has a better win rate.